Hantec Markets'e gideceğiz. Piyasa analisti Richard Perry olacak karşımızda. Hi Mr. Perry, welcome on show.
Hi.
Markets focus on Fed's meetings today, and what are the main factors to watch from the FOMC?
Well, I think that it's going to be a meeting that is not going to be containing any rate hikes. I think that's fairly well considered now by the market. But I think that there are different aspects to look for. You've got to look for the start of balance sheet reduction. Look out for the dot plots as well. But I think the main focus, I think, for today, for the historical side of this meeting, will be the balance sheet reduction. The announcement that this $4.5 trillion balance sheet that the Fed has is going to start to be wound down. I think that that has a long-term hawkish impact, and Fed officials have suggested that perhaps as much as 1% on the quantitative easing has actually cut 1% off the Treasury yield on the 10-year, and I think that that could be unwound in the coming years. But I think that's more of a longer-term factor, and I think the near-term aspect of this meeting is going to be driven by the dot plots. And I think these dot plots, the markets will be focusing on how the inflation forecast is actually impacted by the hurricanes, but also the dot plots in terms of how the interest rate expectations for the longer term at 3% are changed. If that 3% figure is brought down to maybe 2.75%, then the market's going to take that as a near-term dovish move, and that's going to pull yields lower, and that's going to hit the dollar on a near-term basis.
And Mr. Perry, what do you think about the U.S. bond yields performance?
Yeah, Treasury yields have spiked higher in the last week or so as the expectations of a rate hike have sort of improved again as the inflation data came out a couple of weeks ago. The 10-year yield went up to 2.2%, and this has changed what had seemingly previously been a medium-term downtrend. That was broken, and 2.2% up to 2.3% is a bit of a key pivot level. If you can see the 10-year yield breaking through 2.3%, I think that would continue to really push the 10-year yield on, and I think ultimately the 10-year yield will be driven by this balance sheet reduction and potentially, as I said, further forward the inflation expectations. If those inflation expectations are not cut by the Fed today, that could drive yields higher, and that will be an aspect to look out for as well.
And finally, let's talk about the FX market, especially euro-dollar and dollar-yen and gold and sterling.
Yeah, we've seen, I think, the market's consolidating today, and I think that's natural in front of the Fed. And I think the market will be looking out for perhaps if the Fed, as I said, if it cuts that longer-term rate, the terminal rate from 3%, if that cuts that, then you'll see a dovish move from the Fed, and I think the dollar will weaken. That will pull euro-dollar above 120, and it also will be looking at supporting that gold price as well. Gold has been hitting a floor of 1,300. That's a key level on gold, and if it can continue to hold above 1,300, and that will come on, the likelihood would be driven by a dovish Fed, then that will continue to find the support. I think the interesting FX pair to watch out for, certainly of the moment, is also cable, where sterling has been flying around on the expectations of UK monetary policy as well, and add in the added impact of the Fed tonight, we could see some further volatility on cable.
And I want to ask last question about emerging markets. What is your opinion, the potential effect on emerging markets after the Fed decision?
Well, it depends on how the markets really react in terms of the longer-term aspect of this balance sheet reduction, because the Fed pulling yields high, if the longer-term yields pull higher, that will help to strengthen the dollar, and that will have a negative impact across emerging markets. And I think that would be the takeaway to look from that.
Thank you very much for details. Thank you very much for joining us, Mr. Perry.